Warning: this video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Right, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. I actually think this weekend is going to be more of a shallow dive, so I'll try to keep this as short as possible and just give you the cliff notes. There's a new piece of inflation data, or a couple of new pieces of inflation data, so we'll run through that. And then I want to put most of the focus on the charts, look at the weekly closes, and see if we're still set up for higher prices over the coming weeks. So, of course, the base case for the stock market was that the lows were too bearish, you'd have a blow-off top to all-time highs, and then come tumbling down in a recession. And here's the key part, that recession would have a deflationary component to it. Fast forward to today, it seems like we're going to have to move the goalpost slightly. It's not the first time. We often set these temporary third angles and use it to sell into local tops. I have been talking about waiting for a daily cycle low to show up and then use that as the trend line support to set this next angle of ascent. It may well be in already, as you'll see when we get to the charts at the end. This cycle is almost looking like it wants to confirm via time. Anyone familiar with the cycle trading tutorial, the PDF, or the website will understand exactly what that means. If not, I'll explain it at the end when we get to the charts, but it's still my preference, just because it's the most probabilistic outcome, that we will get a quick dip into the week to follow. But just on the off chance we don't, and instead we move significantly higher from here, then we can use this current low and set our angle of ascent from there. And then, of course, the big question will be, does it go extremely blow-off toppy? Do we have to add another third and final blow-off top angle? Or is this what we're going to end up using to exit the market into the next local top? Time will tell. But for now, it seems like the market is in full bore bullish mode, and who am I to argue with that? Of course, once it does come tumbling down, we'll do what we always do, which is take some profit into the local highs. And then if that just remains a local high, we'll do again what we always do, which is wait for momentum to return and get back in. Or if that ends up being the ultimate top, that won't be super surprising since it's been the base case for a while. For Bitcoin, we're still operating with the idea that we find these weekly cycle lows, and then we get, roughly speaking, a doubling from said lows. If we are going to see the same thing repeat, that gives us a current target of around 150k for this weekly cycle. If I hop in and get an updated look at this chart, the only way we're going to get there with enough time left is if the next few weekly candles are extremely big and green. So it's still my current lean. I don't see any reason to deviate away from this, at least not yet. And so long as we can get a couple of very big green bullish candles over the next few weeks, then I would say, wholly speaking, this thing is still going according to expectations. Then we'll look to get a decline into a weekly cycle low, and hopefully there's one final pop thereafter for Bitcoin. As I said earlier, we've got some new inflation data. And again, I'm still making the case anything you do to the M2 rate of change shows up in the CPI, albeit with a lag. I'm still making the case that we are in a heavily disinflationary trend and will ultimately slip into a short period of asset price deflation, since that is what the M2 rate of change has shown us. When we keep an eye on the trueflation, I know, as I say every week and often in the midweek, investors suffer from this disease where they have to zoom in and look at the chart in the short term and make sweeping statements and falsely drawn conclusions, such as inflation has bottomed, inflation is sticky, et al. But we continue to point at this and say this is nothing more than a counter trend wobble within the primary downtrend, just like we saw back here. Ultimately, we have so far got lower highs in place, and I expect this to continue for a while longer. Invalidation on this idea would be that we break above these prior highs, but I really don't think that's the case. I think this trend is going to continue down. And that was, roughly speaking, confirmed, right? We know that because of this counter trend wobble, we're going to probably have 1 to 2 semi-sticky prints. And we did kind of see that in the CPI data that came out this week. It was kind of sticky, kind of in line. Not too surprising, really, especially if we continue to follow this trueflation curve. But then we got the PPI data come out this week, which was new. And you can see month over month, we are at 0% for both headline and core. So again, you can see now, can't you, this down, sideways, and down, which when we go back to the M2 rate of change, perfectly marries up with this down, sideways, and down. So again, no real surprises for the Camel Crew here. Inflation's still going our way, still undoubtedly, at least from my perspective, in a heavily disinflationary trend. And yes, there'll be counter trend wobbles along the way because nothing moves in straight lines. But ultimately, I do expect this trend to continue, broadly speaking, to the downside for a while longer. As for the unemployment data, depending on which metrics you use, depends on how good it is. We keep seeing revisions. There continues to be complexity. But similarly to the inflationary trend, this thing is still moving, roughly speaking, in the right direction according to our expectations. And that is that we are seeing continuation of labour market deterioration. I heard Henrik use a very interesting but well-fitting analogy, and he was saying that with the unemployment data and the way the economy is moving towards a recession, it's akin to trying to turn a very large shipping boat or a barge ship, whatever they're called, those huge container ships, unlike a jet ski where you can just turn the handlebars and then pull the throttle and the thing will whip around 180 degrees in under a second. When it's a large container ship type deal, it takes a very long time to slowly turn that thing around 180 degrees degrees. And that's kind of what we're seeing with this economy head into a recession. It is trending the right direction. It is moving towards recession. We are seeing labour market deterioration over time, but just like a big barge ship, it's taking a very long time because it turns very slowly. So great analogy there. It very much fits what we're seeing in the unemployment data. We have had marginal improvements as we've been covering the last few weeks, but nothing sustainable yet. Okay, if this persists and sustains, then this thing can roll over, happy days. If not, then we are still at risk of seeing this big explosion, which is synonymous, of course, with recessionary periods. That exact same idea and principle is applicable to the U6, which again has showed marginal improvements over the last few weeks, but is nothing to write home about yet, and we are still at risk of a big spike in the U6, again synonymous with recessionary periods. The exact same principle is true of the SAM recession rule. We have had marginal improvements at the hard right edge. We've, for the first time in a long time, got a lower low print, but one lower low print is not enough to cement a trend change, right? This will need to persist and continuously roll over. Otherwise, we will still have to entertain the idea that this thing could be about to spike as we get closer to those recessionary periods. No changes to the rates either. We apparently are going to continue to be paused in July's meeting. I again continue to make the case this is overly restrictive because the Fed is significantly behind the inflationary curve and because the labour market deterioration has not yet shown any real significant signs of improvement, at least not persistent signs of improvement. And I still am making the case that ultimately this is going to end up proving to be overly restrictive and result in panic cutting from the Fed. That is of course to be determined. And the last couple of things I want to just quickly check on is number one, the high yield credit spreads. We've been talking about breakouts here being synonymous with financially stressed conditions, but moving back below the breakout level, and I've been calling for a chop below this level to range in here. Anything like that, okay, should be conducive to higher risk prices in the short term. Once this thing does eventually break out again, I think it's going to be time to really pay attention here because these big breakouts tend to be alarm signals that the top is coming for the stock market, if not already in. And I use a very similar principle for the yield curves. This here is the 10-2 yield curve. When this thing inverts, everyone screams recession. They're wrong. When it reverts back above zero, they scream recession. And again, they are wrong because it's the acceleration to the upside that is synonymous with the tops coming in. So similarly to the high yield credit spreads, we also check on these as a kind of smoke detector or alarm bell. When any technical breakdowns start to occur in the stock market, we can come here and check to see if these are for real or whether they're more likely to be local tops and set us up for re-entry once momentum has returned. And again, fitting in with this theme of the shallow dive, you can see no real changes in a number of weeks. So that's good, okay? Sideways is good, conducive to higher risk prices. Down is also good, conducive to higher risk prices. It's only an accelerative sweep to the upside that we have to start to take seriously as a true alarm bell or recession signal. As you can see, the accelerative sweeps usually mark recessionary periods. This was the C19. This sweep here was the GFC, and this one was the dot-com bubble. Once again, we can sharpen this yield spread, changing the 2-year yield to the 3-month yield. Again, you'll notice dot-com bubble, GFC, C19 era, all of these accelerative sweeps marked the top was already in the stock market. But when we zoom in on the hard right edge, again, this thing is continuing to range sideways. So no alarm signals just yet. No alarm bells need to be ringing. And of course, none of this is occurring with technical breakdowns in the stock market. So all the while, the stock market continues to push above support and hold support, then we can remain long and strong. I even think we could weather a pullback here and then reset this angle so that it's not quite as vertical as it is currently. But of course, start to break trend lines, start to confirm via failed daily cycles, especially against a backdrop of accelerative sweeps in the yield spreads, high yield credit breaking out, and of course the other warning signs such as the labour market type signals, SAM recession rule, U6 et al. Breaking to the upside would all be a sign that taking profit there and getting out the way, sidestepping the drawdowns would be the most prudent move. So with all that said, let's pull up the S&P 500 chart and see what we've got. You can see that I've been calling for a pullback into a cycle low. Most of the time, this is what we'll get, okay, a pullback into a cycle low. I still kind of have that lean because the timing-based lows are so rare. When I was going through them with the members or the Slice crew, I forget which one, it took me quite a while to even go and find a prior example. I had to go through the stock market, through Bitcoin, and then into gold to be able to find an example of a timing-based low. That's how rare they are. I was scrolling back for a good couple of years on each one of those charts, and I could only find 2 examples of timing-based lows. So it's still not the smart bet to suggest this is a timing-based low. On a balance of probabilities, we should probably see some kind of swing low and pivot to get behind. And again, then we can use that wherever that pivot forms as the trend line. But very occasionally we do get timing based lows, and this looks like a sideways consolidation, and the cycle confirms via time as opposed to a swing and a pivot. So the marker for this will be, we'll wake up one day to see a big green candle. That will confirm we've got the start of a new cycle. We can use things like the Bressa indicator down the bottom. That will allow us to detect bullish momentum shifts as well. And of course, if we do get a big green candle, the camel cycle low indicator will pick said cycle low. But as I said, these setups are incredibly rare, and so on a balance of probabilities, my current lean is still that we will get a quick 1 to 2 day decline to give us a cycle low, a swing low, and a pivot. For gold, it appears like this thing is bottoming slowly but surely. It seems to me like we're compressing into some sort of a triangle, getting ready to move higher. Of course, invalidation for this will be failed cycles, but at the moment we don't have that. So whilst this is quite consolidative, I think it actually does make sense to digest this move for a little while, since we did have such a strong move to the upside here. So no real changes to the plan there either. Still leaning bullish gold until such time as failed cycles show up. At the moment, I still think we possibly are absent of a weekly cycle low. And the reason I say that is because if we put it on the weekly time frame, you can see the Bressa is yet to cross down the bottom. So we may need to do a little more digesting of this move first before we can start to move higher. But ultimately, my current lean for gold is still that we are going to see another push to new highs in the not too distant future. For Bitcoin, as I said earlier, I'm still expecting to see this push towards 150k in the next few weeks. If we don't get that, then we're going to have to start to put some other scenarios on the table. But for now, we are looking pretty bullish to me. We're at fresh highs, so I don't really see any reason to doubt such a powerful trend. Some kind of pullback here into the 20-second time frame gives a half cycle low for Bitcoin, which again would align with that 20-second time frame for the S&P 500 and the US equities. So a little bit of weakness for a couple of days makes sense to me, but I don't think we're going to see any kind of severe decline here. I think we're probably just going to kind of chop around for a little bit more, maybe one final marginal lower low, and then I think it's going to be resumption of the upside. We have got quite a lot of ground to cover here. We've got to do about a 30% move over the coming couple of weeks. Now, I think Bitcoin can do that in its sleep. I don't really think that's impossible, but again, we have to acknowledge the data in front of us. If this thing doesn't start to move, then perhaps we are going to have to lower some targets and figure out what's going on under the hood. Similarly to the rest of these charts though, for now I don't really see any reason to doubt this trend, and we're long and strong. We're also long and strong a bunch of these crypto related stocks. They're all doing really well as well, right? We've grabbed hold of these in the level 3 members. We hold a bunch of these in the longer term accounts as well. Coinbase is getting very near the long term take profit zone, so again, if you're a level 3 member, we'll deal with taking the profit on that. I'm noticing a bunch of these other ones like Hut as well doing extremely well. So I mean, things are still going, roughly speaking, in the right direction. We're even starting to see a bunch of these altcoins start to do well here as well. XRP at fresh all-time highs. Ethereum catching a nice little pump here, on its way to new highs perhaps. So we'll see if that can happen. But wholly speaking, this is a bullish market, right? And who are we to doubt that? So all I can really do is say, so far so good. Everything's still going, roughly speaking, according to plan. I still can have plenty of confidence in my position and in posturing. And as ever, we'll continue to take this thing one day at a time. We'll keep coming back here on the weekends and running through this. As we get some more data to assess, we can continue to analyze that. So if you're a level 3 member, look out for the members only video I'm about to post for you guys. For everyone else, I hope you're doing well in life. I hope you have a fantastic weekend, and I'll see you on Monday for some Crackpipe Monday ideas. Until then, all the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game.